Hello everyone, welcome to my YouTube channel. And today I'm really excited to share another video in specifically training and education series. So the whole goal of this channel is to spread the knowledge and genuine insights and teach people so that they can be aware and they can take more informed decisions regarding the financial markets. So when I started this channel, the way I have structured this channel is in the form of multiple playlists. And this playlist is specifically dedicated to training and education. So in the last video, in the same playlist, I discussed my journey of financial markets, why I came to this financial markets, and I compared a lot of other businesses and other asset types. And today, I want to specifically talk about capital markets, which is general term for financial markets. So basically, the whole goal over here is to teach the people from ground up, starting from the basics. So that is why let us jump in to today's topic, that is capital markets, and let us try to answer some basic questions and some reasoning and some logic behind the things that we do and how we do it. Right now, let us talk about some of the important basics. And after getting a lot of feedback, I have jotted down some important but basic concepts and basic questions that anybody who is not related to finance may have. So what I did is I structured some of the important and pertinent questions that we can answer so that people can have a basic view of what is financial markets and what is going on. So first question is, what is stock market or what is capital markets? So normally, if you look at any major developed economy or any big developing economy, then you will realize that any of those countries will have a very growing and vibrant capital markets. So normally, some of you might be working in big tech companies, some of you might be working in mid-sized firms, some of you might be working in the startup, right? So there are lots of companies which needs financing, which needs money to expand. So normally there are two ways in which a company can do that. Either they can get the funding from early seed investors, or they can issue a lot of debt, or they can have loan on the company. So many a times what happens is when a company becomes sizably big and when they have real growth potential, there are a lot of financial criterias which a company can suffice, and then it can get listed to the stock exchange. Now, what happens is it comes with an initial public offering, that is an IPO. So normally, companies advertised their prospectus, and reading that, people like you and me can have a fair idea about the company, and they can decide whether to invest in that company or not. Now, when you actually buy a stock or a share in the company, you become a part owner of that company. So let us assume that a company has 100 shares. So 100 shares meaning the each share constitute of 1% of the company. So let's say I buy five shares, then I become 5% owner of that company. So this is a very nascent and basic view of stock market, like what it is. Basically, whenever you buy a share of a company, you become owner, that is proportional owner of that company, depending on how many shares they have outstanding. So this is basically a very brief introduction of what stock market is. Stock market is a place where all the companies get listed on the exchange, and then people transact over that exchange, and people take the ownership of such companies which are listed. Now, I wanted to answer another basic question, like how can I participate into stock market? So there are a lot of ways in which American people or any citizens of the world, if they have a stock market in their country, they can participate in many ways, and a lot of them don't even know that they are actually participating in the stock market. So let's say, for example, whatever kind of job that you are doing, let's say if you are contributing to the retirement plans like 401k or Roth IRA, actually you are indirectly participating and investing in the stock markets. So there are a lot of ways you can actually buy the shares by yourself individually, or you can go to the mutual funds and then they will invest on your behalf. So there are direct and indirect ways in which you might be investing in the stock markets without your knowledge. So I wanted to get this thing very, very clear that you might have exposure to stock markets in the form of retirement plans like 401k, Roth 401k, Roth IRA, and so on and so forth. So the next question is, what the hell is this 401k plan, or what the hell is this Roth IRA plan? So many times what happens is, when we work for companies, the companies provide us with the perk of the retirements, and in that perk they give you a some sort of matching. Either they match dollar to dollar, or they match 50 cents on the dollar, it up to the 5 or 10% of your base salary. So whatever may be the criteria, you can check with your own company. But this is the way where most of the Americans participate in the stock market, if not directly, if they are not buying stocks directly. So this is one of the ways that you can participate, and probably almost everybody has some sort of retirement plan which is tax advantage plan as well, because some of these plans gives you tax exemption as well. So that I wanted to discuss that, like, this was the primary way or medium in which people participate into stock markets. Now, the structure of stock markets, I wanted to clear some terminology. So there are, when you talk about markets, there are, three main indexes in US specifically. Now, what are those three main indexes? The first one is Nasdaq index. And what is basically an index? It is a collection of the best companies out there. So if we talk about Nasdaq is a collection of the top 100 tech related companies. And same way, the second most popular index is S&P 500, and that is basically the collection or the basket of the best 500 corporations of United States. So that is S&P 500. Also, there is a third index which is very, very popular in United States, and that is Dow Jones. That is the basket of 30 very big companies. So you can have a look upon which companies are included in these baskets to have a fair idea or a detailed idea of what these indexes constitute of. But normally these are the three big indexes in US stock markets. Now there is a fourth small index as well, which is called Russell 2000. Now Russell 2000 is basically a basket of mid-size and small size companies, and it's a basket of 2000 of those companies. So essentially those people who want to be a part of a growth story, and who has a lot of more risk appetite, then they can also go into these a basket of small companies as well. So I just wanted to highlight what the indexes are, and how many indexes does United States have, and what does it constitute of. So this is basically the meaning of indexes. Now, the other thing that I wanted to discuss is investing. So when you come to capital markets, there are a lot of ways to make money, and one of the two most prominent ways that are out there, which are time tested, is one is investing and other is trading. So what is investing actually? So think of it as a business. So you take an ownership of some of the companies that you like, and then you keep them for a long amount of time, in the hope that those corporations will do well in their business and thereby increasing the value of the shares or the stock that you hold in that company. So essentially, investing is buy and then keep it for a long time and then sell if you have to. So essentially, on the base level, this is what investing is. And what is the term that I used is portfolio. So what is portfolio? Portfolio is basically in the investing, if you go with one company and what if that one company does not do well, then you are done. So in order to not let those kind of scenarios happen, what people do is they try to diversify their investment into different sectors, and they divide their investable capital into different percentages, and then they hold a portfolio which comprises of many different companies, so that let's say a certain companies in your portfolio goes bankrupt or doesn't perform well, the entire net worth doesn't get affected. So that is how one of the strategies that, that portfolio managers swear by, by saying portfolios. So this is the meaning of portfolios. Now I wanted to also discuss, like, okay, we talked about capital markets, we talked about stocks. Now capital markets is an umbrella, it's a very big market. Now there are lots of instruments that you can invest in. So the one of the instruments is stocks. So you invest in shares, you buy and sell shares. There is also different instruments called bonds. So bonds is basically United States government is issuing a contract to you in the favor of a little bit of interest. So let's say if I buy a bond, essentially what I'm doing is I'm giving my money to US government, and then US government will return that money with a tiny bit of interest, so that I can gain some return over the course of a certain duration. So bonds can be 6 months, can be 10 years, can be 30 years. So the duration may change, but bonds are essentially the government contracts which gives you interest on your capital for the amount of years that you keep the bonds for. Now bonds are also of many types. Companies also issue a lot of debt, and you can hold that as well. So I don't want to go into details of each thing, but I wanted you to understand the basics of it, and let me know if you want me to cover something in detail. I would be more than happy to do so. So let me know in the comments. So moving on to other instruments. So consider capital markets as a mall, and in that mall, there are multiple showrooms. Let's say one is stock market, another is bond market. Let's say another showroom is commodities market. So commodities market is also very, very big. Commodities market consists of crude oil, precious metals, kettles, lot of things, right? So that's one of the segments of capital market. Then there are other instruments as well. For example, futures, those are derivative products. There are options, those are also derivative products. So these are the instruments in which you can invest, and you can participate into capital markets. So there are a lot of different varieties of financial instruments that you can be a part of, so as to get the returns. So that I wanted to discuss these types of various instruments that you need to be aware of. So the next point that I wanted to discuss is what do I mean by equity? So equity is basically stock markets. Index funds is basically whenever you give your money to active managers, and you tell them that, okay, let's say you are doing a full-time job and you don't have the time to research, and you are not the expert in this field, and you want to outsource that intelligence, then what the best option that you would have is to go for a mutual fund. So basically, a lot of people come together and pool their money and give to somebody else who is knowledgeable, and then they decide where to deploy this collected capital. Essentially is called mutual fund. And for doing that, those fund managers will charge you some expense ratio for their fees. So that's essentially what mutual fund is. Now, when I talk about index funds are pretty much the same with one very key difference. Now, a lot of people come together to pull their money and then they give it to someone to manage. Now, that someone, if it's an index fund, the charge that they are going to take is very, very low. That's the first difference between index fund and mutual fund. And the second is the mutual funds are not, legally, ruled, or they don't have to abide by the rules of, you can invest over here or you can invest over here only. For the index funds are, let's say that fund is indexed to Nasdaq index, so they can only invest into the Nasdaq markets. So Nasdaq, index comprises of 100 companies, top 100 tech companies, so they can only invest over there. So index fund is very, very directed. It's a very, very specific kind of investment, and the only good part about index fund is it has a very less expense ratio. So that's and when I say expense ratio, it's not a confusing term. It's just a term for the amount of fee that you will give to the fund manager, who is going to take the decisions on your behalf. So that's a very basic meaning of these terms. Now, the bond I already covered in detail. ETF. So there is also a instrument called exchange traded funds. So what does it mean? It means that these kind of instruments are traded on the exchange. So if you talk about mutual funds or if you talk about index funds, they have a unit, and that unit has a value, and you can't trade it like every day. It's that unit, or it can only be their value can only be determined at the end of the day. So if you own the ETF, that instrument you can actually trade at the middle of the trading day as well. So there are some peculiar difference between ETF and these funds, that is index funds and mutual funds. But I'm just highlighting notable differences in all of these instruments over here, so that you get a basic idea of what these things are. So finally, coming to the derivatives segment, that is futures and options. So these are very, very complex instruments, and the reason why they are called derivatives is it derives its value from an asset which is correlated to it. So for example, let's say if I talk about Nasdaq futures, which I trade very frequently, then the value of that Nasdaq futures contract will depend on the Nasdaq index. So that's the correlation, and that is why they are called derivatives. So futures are basically a contracts which are traded from the financial speculators to the actual producers of those asset type. So for example, you can trade Nasdaq futures. You can also trade let's say precious metal futures, or you can also trade life hog futures. So there are a lot of futures. The futures market is very, very vast, and most of them is based on commodities markets. So you can trade currencies, you can trade crude oil, lot of futures instruments to trade with. Now coming on to options. So options is also a type of derivative instrument. It is structured very, very differently. Both of them have expiry dates, and both of them has delivery and everything. The major difference between futures and options is you can have a lot of clarity and you have to worry a lot less in terms of futures than in terms of options. So for options, you need to also know all the Greeks, that is delta and rho and a lot of implied volatility and whatnot for the pricing of options. But for futures, you just need to know what the underlying asset is doing, and you don't need to worry about all these things, all the other variables. So there are a lot of options type as well. So if you want to have a long position, then you can go with call option. If you want to go with a short position, then you can go with put option. So there is a lot of details into this instruments. So I would highly recommend that before trading and before investing into these kind of things, be very, very aware and do a lot of research. Many of the companies, let's say in which you are working on, even they may provide you options. So let's say if you're working for a startup or a mid-sized firms which offer you options as a form of compensation, then they will offer you a strike price in which you can actually exercise the options that are awarded to you. So there is a lot of details to each of these instruments, and let me know if you want to cover some of these instruments in detail. I would love to do that. So I just wanted to give you a gist of what financial markets are, and what are the various options available, and how are they constructed and whatnot. So this is a very basic understanding of capital markets, and this is are the questions, or I would say FAQs, that everybody needs to know before coming to the financial markets, so that they can be aware and they can make an informed decision. So these are the concepts that I wanted to discuss as a part of learning series, or the basics. So these are the basics that everybody needs to know. So I know that this has been a long video, and I'm really sorry for that, but this is very, very important pertaining to all the viewers, because this playlist is really, really important for me, and I want everyone to understand the underlying dynamics, and slowly but surely I will cover the advanced topics of trading, and I just wanted to build a really good foundation so that people have a fair and reasonable idea about what I'm talking and why I'm talking. So thank you so much for viewing this video. Please feel free to like, share and subscribe, and send it to your friends who wants to learn more about markets. And with that, I would like to wrap up this video, and I will cover the advanced topics and further topics in the next video, which is specifically in this learning series. So keep a close eye on this training and educational playlist on my channel, and until next time, see you guys.